Good morning, afternoon, and or evening. Welcome back to Lamb's Cryptoverse. Today, we're going to go back to that education series and talk about analyzing a crypto or whatever you want to call it, blockchain or digital asset projects' unique risks. So not systemic risks, but idiosyncratic. Say that 10 times fast. Idiosyncratic, unique risks. So remember, I say this over and over, crypto projects must be analyzed like a three-legged stool in a holistic way. You've got macro, which usually relates to systemic risk. Then you've got fundamentals, and today we're going to be focusing on one specific aspect of fundamental research, and that's, like I said, idiosyncratic risk. And the third way of analyzing crypto, there might actually be four ways, but the third way is technical analysis, which is charts and trend line and Fibonacci's and all that. The fourth one, which actually could be included under technical analysis, is sentiment. That's very important. So what the heck is risk? You can read this on your own. I encourage you to stop the presentation and print out the slides. So I think we all know what risk is. There's a few definitions. I'm going to give you one. I'm not even sure if it's on here, but one way of looking at risk is volatility. But I think the best way is drawdowns. How much money can you lose? That's really a big factor of risk. Actually, even better than that, let's refine it. How much money can you lose compared to what you forecasted? So that's how I would define risk, or you could read what I wrote here. What else? And we already mentioned the two types of risk, systemic and idiosyncratic. And of course, there's ones that are used in books that have to do with variance and standard deviation, which we won't talk about today. So why do I only focus on risk and not return? Because everyone in this niche, meaning the area of blockchain crypto, everyone focuses on return. Oh my God, you can make 1,000% on this coin, buy this NFT, buy this meme coin. I don't do that. I only focus on risk because remember, we're playing with fire. So if we're playing with fire, we shouldn't worry too much about return. We're going to get those returns once the coin market goes up in price. Once we get liquidity and the Fed starts printing again, crypto is going to go up like crazy. So don't worry about return. Worry about risk. And remember, the crypto space is analogous to venture capital. It is extremely risky. I just read the other day that I think it's 14,000 meme coins or NFTs are worthless. So just think about that. So this is extremely risky, riskier than venture capital. So keep that in mind. And remember something else. This is something nobody talks about. Eugene Farmer, if you studied for your CFA or you went to graduate school for your MBA, we studied EMT, efficient market theory, and we talked about this professor called Eugene Farmer, and he spoke about the three forms of EMT. That's strong, semi-strong, and weak. So if you believe the crypto market, as I do, is inefficient, then that's the weak form of EMT, and I suggest that you look that up and learn about it on your own. So, and I'm saying to learn this stuff on your own because there's a lot to talk about. I want to try and get this done in under 12 minutes. So, types of idiosyncratic risk. I'm only going to read you a few. I suggest you print this out and save it and put it up on your wall. So, the types of unique risk are regulatory if it's per a specific coin. For example, if the SEC says your coin, your crypto project is a security, that's a unique risk. Then there's a hacking risk, software bugs, lawsuits, key man risk, very important. Forking, meaning the coin, the project splits up into different coins, Ethereum and classic Ethereum. Where were we? Staking, is there a bad malicious validator? Number 8, Are we dependent on centralized components that can control the blockchain, the team's integrity, partnership risk? Who are your friends? Are they bad actors? Point number 11, competition with blockchain. Is there bad code? Number 12, competition with incumbents. Are there incumbents, legacy companies like Google that have lots of power and control? Treasury mismanagement, lack of adoption and network effect. Is the blockchain, or the developers, I should say, of the blockchain operating in risky sanctioned countries like Russia? And lastly, does the blockchain have weak tokenomics? And there's a lot to talk about just alone in number 16. But we have to focus on moving forward into the next slide. So one example, going towards the previous slide, is the list of hacks. So if your blockchain is not secure, it can get hacked. And we all know that Solana got hacked many times because of many reasons. But one reason is because they only have one software, what do they call it? Service software. But going forward, they're going to have what's called Fire Dancer, which is going to make their blockchain more robust and stronger against being hacked. But right now, that hasn't come out yet. So Solana could still be vulnerable to a hack. And you can see there's many other hacks. This is just a few. Polkadot's not here. Polkadot also got hacked when it first went public, when it ICO'd. So sources of information, you can read this on your own. These are the typical sources of information on idiosyncratic risk. I think out of all of these, the best ones are some you have to pay for, like Messari, Delphi Digital, Token Insight, Crypto EQ, and where else? And you can even look at blogs. So here, I'm going to spend some time on this. There's a lot to talk about. So what are specific, unique risks for specific projects? Avalanche. You could read this on your own, but they do not have integrity. I read from various sources, you can read this, that they did malicious things or somewhat malicious things, like saying that they had low inflation when they had high inflation. There's rumors that they hired a law firm to attack other projects, and on and on. And some other unique risk, or I mentioned this already, forking and Bitcoin Cash, Ethereum Classic. Chainlink has lack of transparency. That's a no-no. Cosmos has keyman risk. FTX, there were rumors that Sam Bankman-Fried was shorting some projects that FTX was involved with, and we saw that actually came true. And Solana was associated with FTX and Alameda. That's another bad thing. And because of its association with both FTX and Alameda Research, we had multiple issues, like the Solana's treasury was in Serum and FTX coin, so they lost perhaps most of the treasury, but we don't know. Solana has never publicly said what the treasury is, and the treasury is not on chain. What else? Layer 2s, they're dependent on Ethereum. That's a unique risk. And there are many blockchains. I only listed a few here. Many blockchains that do not have adoption. And Celsius, there was a lot of a unique risk here in terms of commingling of customer funds, and the CFO was arrested for fraud. I'm going to talk fast because we're running out of time. Terra Lunar, lots of issues with technology, meaning using a unique way of creating a stablecoin. There was a lack of transparency and centralization, meaning control. And XRP/Ripple had a huge lawsuit with the SEC. So final thoughts. I use risk as an overarching factor when I rate my blockchain, my projects, and have a very deep rating scorecard that covers several factors. But I include risk as a big make or break factor within that. What else? Determine if the risk factor is short term or a long term one, like integrity. What else? Oh, yeah, this process that I've been using for a few years now has kept me out of several projects that just blew up, like Celsius, FTX, and Terra Luna. Well, thank you very much for listening, and I hope you enjoyed this. And don't forget to like us, smash that like button, and subscribe to us. Bye bye.